Not quite when it comes to the equity markets. In fact, anything but, because sentiment has certainly soured across the board when it comes to different asset classes, in particular with the rising tensions between Israel and Hamas. So just to put things into perspective, let's just take a look as to what the 1 week of the geopolitical strife and the impact of the geopolitical tensions have had on different asset classes. For instance, we've seen a spike in crude oil prices that has been quite significant, to say the least. You had them seeing quite a rally on Friday's session, and that did manage to reverse. And you did have a fresh blow as well being dealt to the global economy on the back of all of that news. Gold prices, for instance, as well have spiked about 5% to about $1,926 per ounce. You've also got the emerging markets, MSCI emerging markets, the CBOE volatility index, and the dollar index as well, seeing some sort of a move. So Nikunj as well joining in on the show. And morning, Nikunj. Clearly, we're looking at the overall impact of the geopolitical tensions across asset classes.
See, Avan, look, what are the headlines? The headlines clearly are something which are not really very kind in nature. Bloodshed, destruction, no truce, no evidence of any kind of a ceasefire. So news, at least from on the geopolitical front for next couple of days, who knows, it could be weeks or months also, is not going to be market supporting. But the point you would ask yourself is that how much of this geopolitical tension will have a cascading impact on the financial market per se, on the commodity prices, the supply chain, and how things on the economic frontier will move. I continue to maintain that you will see spikes and you will see reactions in asset classes, but they will not be scary. The upticks and the downticks, I think the upticks would be very measured. This is not Russia and Ukraine where it was a war between two countries. It is something which changed the entire geopolitical landscape. It had far-reaching impact on energy. It had far-reaching impacts on the yields and the underlying risk premium. There are three things which matter. Cost of energy, which in the near term will be hard to call. Impact on yields. One looks at the 10-year paper and the global bond yields, they've not really shot up. And third, the geopolitical, third, the risk premium and the volatility index, which is CBOE VIX, which is still south of 20. So global financial markets are clearly messaging very simple that yes, this is something which markets are not very happy about, but markets are also not very scared about. So the best strategy in this market, if you're watching the show, I guess is simple. Stay long in the market. You got to be a buyer on the bad days, and just don't go short because there are geopolitical problems somewhere in the world. I think the approach for a day trader and for a positional trader is stay long, buy the dip, and don't go short.
Okay, stay long, buy the dip, and do not short in a hurry. That's the messaging, and that's exactly what we have been doing for last week as well, because Nifty has managed to gain for a second consecutive week. If you look at the last week performance, in fact, it was the highest gains that we have seen in the matter of 4 weeks already. Real estate pack that continues to build on gains. So Nifty Realty Index was sitting at record high level, and solid moves across the board is what we witnessed in the week gone by. Having said that, it seems like there's some profit booking which is underway when it comes to the PSU banking space. So that was the top sectoral loser, and Nifty Bank that has been falling for the fourth consecutive week. And the question is, Nikunj, when will Nifty Bank come to participate? Because whether it's heavyweight, HDFC Bank, ICICI Bank, or the rest, they have been weak in the week. They have been on the back foot in the week gone by. Though autos and realty started making a bit of a comeback.
I'm reading the CLSA India strategy note, and the second para of this is that the non-India dedicated funds, which is for institutional investors, they're selling India and they're reducing their exposure to India. And FIs have cut their overweight in financials by 10 bips to an all-time low of 5.5. So they've cut their positions in financials largely because of compulsive selling which they have. So I think financials are going through a patch of compulsion rather than a patch of derating. Yes, 2022 was a big comeback year for banks, but 2023 has been a quiet year, and stocks can consolidate, and I think that is what the consolidation, and that is what we are currently going through. I don't see too many fault lines in the numbers. I know a lot of brokerages have come out with their assessment on SBI and other financials that they're expensive, but I beg to differ. For me, yes, the earning expansion, the credit expansion cycle is not over. NPAs are under control. Interest rates are likely to move higher. Of course, the peak profitability in terms of percentage will not be as strong as what we saw in FY23. But given where the growth, the visibility, the ownership is, and the profit of valuations is, I think financials will make a comeback. I mean, it's a matter of days or weeks. I don't know. It could be after the earnings season or it could be next calendar year. But I'm ready to stick my neck out and say that financials is where you want to be in. You want to be in financials. First, private banks as a contra call if you're looking at a theme-based investing. Then look at NBFCs which have a large wholesale book because NBFC interest rates are coming down. And see, I will not be surprised that given what we are getting from some of the AMCs and insurance stocks also, they will come back with a laggard. But I think they are also looking good for some cherry picking.
Okay, sticking your neck out and saying that financials, in particular the private banks, are good for an opportunity. Speaking of private banks, it is going to be all eyes reined in on HDFC Bank because you have the combined entity for the first time that will be delivering their numbers today. And we're going in with expectations that the profit could come in at around 14,800 crore rupees. Of course, we'll be watching out for the monitorables on their overall margins, the net interest margin trajectory, loan and deposit growth, as well as asset quality. But that's not the only thing we'll be watching out for. It's a very busy week. You've got big numbers, the likes of Bajaj Finance. We'll be watching out for Bajaj Auto, Ultratech Cement, HUL, ITC, both coming out on the 19th of October. And then there's also the likes of a Geo Financial, Nikunj, Paytm, Tata Communications. So take your pick. Everything's going to be closely monitored.
Okay, so the interesting bit for me would be FMCG, and it's like the most under talked about and the most disregarded sector, but purely looking at what the moving part for the quarter gone by was, the moving part for the quarter gone by was change in commodity prices and some kind of in volume outlook, which I think you will get from, let's say, companies like HUL and ITC. ITC after that hurrah at the in the mid part of the year has flattened out. HUL has done nothing. So if you're looking at a large commentary which I think should come from a particular sector, I think it would be a combination of Nestle, HUL and ITC. IT we've already heard. Bank, there's nothing dismissive, which is the third big sector. Then you left with autos and to some extent consumer. And consumer staple is what you are likely to get a sense this week. I think Paytm numbers would also be crucial, even though markets know that the trajectory is going to be important. They've shared enough and more in terms of forward guidance. So nothing specific is expected from Paytm per se, at least in this week. But in terms of a tone and tonality and the set tone of the communication, I think it really would be consumer staples as a category or as a cluster.
Okay, so of course Paytm is one stock that we'll watch out for. Today, of course, there was a brokerage upgrade as well that came by. They have increased the target price, not by a whole lot, but just around 50 rupees. But nonetheless, Goldman Sachs is something which has increased the price by 50 rupees to 1250. So let's watch out for that. There's still quite a bit of headroom on that, almost 300 rupees, because they say that the operating metrics have surprised positively. But what's also surprised positively is the big move that we have seen in crude prices. But the big question is it just a transient move, or we are more likely to see this 91 level for longer? All of that will be answered by Jonathan Bharat. He joins us on the show. Jonathan, hi, good to have you on the show. Thanks so much for making time. That's exactly the first question. What's your view on this one-day 5% surge that we have seen in crude prices?
Yes, good morning. Look, very, very volatile move from last Friday. There's no doubt about it. Obviously, it's all got to do with the Middle East and what's happening within Israel and the Gaza. I really think it's more concern there that Israel will put troops on the ground. That, to me, is a major issue. If that is the case, then I think you'll have a concern that might spread into the Arab states and associates. If that is the case, or even regardless, it's going to disrupt what we already know. And if that's the case, then oil could go quite higher. I guess if we get through 92, 92.50, it's on its way to 100.
Okay. Jonathan, one is the impact on crude because of risk premium, because of geopolitical tensions. Now that is something which cannot be measured. What we perhaps can measure is that if the situation in this entire region does not improve and if there is no ceasefire for next couple of weeks and months, what could be the real impact in terms of the supply chain disruption and also in terms of production?
Look, I really don't, there won't be a lot in way of the supply constraints, I guess, as a result of the conflict. But what I do think is that there is a concern there for Arab states to become involved. And if they do become involved or they weigh in to any degree, then I think that is the concern that we're unknown. Although they have stated, or the Arab states have stated, or other OPEC members of the Arab state have stated that they're not going to be involved, you never know, and the markets certainly aren't concerned about that. It is a very different scenario than we had in 1973. This time round, the US is the largest producer of oil, so it's not as extreme. So I don't expect to see the extremes tested. But what I do see is this macro will create a concern, and also this conflict will create concern on the security of oil or potential security of oil, and therefore I see it trading higher. So I think it's not the immediate supply, it's more the talk of it that's going to cause the move.
Okay. So Jonathan, if you're a crude bull, would you say that, look, markets are underestimating, forget geopolitical tensions, the impact what the US demand could also have, given that winter month is approaching and the economy is back on track?
Well, I guess it's if the economy is, as you say, is back on track, others would differ. But I do get a sense that where you're seeing with crude, prior to this concern, we already had supply constraints. Regardless of where the US actually produced, we've had those supply constraints, and that caused oil to go up to US $97.50. So with this new macro, I think it's sort of highly likely that it will. I think if the economies do start to turn, and if interest rates start to or continue to be hawkish, then I think we'll get a general slowdown in the economies. If that's the case, then I think crude could come under pressure, discounting the fact that we have this conflict in the Middle East.
Jonathan, appreciate your time. Thank you so much for joining in and giving us your perspective. So clearly, we have seen that although there is a little impact with the conflict on Middle East on global oil supplies, given that Israel is not a producer, we have a lot of market participants assessing how it could escalate and what this could potentially mean for supplies for nearby countries of the world's top producing region. All right, that aside, let's put the spotlight on the markets then and discuss the way ahead. What's the outlook in terms of levels? What are our chartists tracking? Kunal Bothra as well as Naresh Mirani joining in. Kunal, morning. We wrapped up Friday's trading session at the 19,750 mark. So clearly 19,800 eluding us. It's a critical week in terms of a lot of numbers that will be trickling in. What is it that you'll be watching out for?
Good morning, Avan. So yeah, I think a lot of numbers trickling to the markets, and I think that could probably play more of a similar effect on the indices, where we would expect the index to remain into a range. Now, broadly over the last 5-7 days, the markets have managed to digest a lot of geopolitical as well as the local news flow in terms of stock-specific results. But I think we've not seen any major kind of a breakout or breakdown. So we're expecting more or less a similar kind of a stance for the indices. The index remained to a range, 19,300 as a major support, where we've tested, I think, 3 or 4 times in the previous last fortnight or so. And on the upside, 19,800, 820 approximately as a resistance.
Okay, so that's a view coming in as far as where index is headed. But let's also take some stock-specific calls as well from our chartists to try and understand where they are seeing value. Naresh, which are the sectors or stocks that you would want to recommend?
So in terms of the view remains more to be defensive, more large cap, because we are still stuck in the range. So going with stocks in the large caps which are breaking out. So first is a buy on Power Grid, which is a percentage point away from a new 52-week high and an all-time high on a dividend-adjusted basis. The stock is making a classical triangle formation out here, contracted range for the last few weeks. Also, the earlier breakout got retested. Expecting this to break out in the short term, stop loss at 195, target price of 220. Second is a buy on IndusInd Bank, which has clearly shown a lot of resilience and has come close to a new 52-week high. A range contraction, been trading between 1380 to 1470 for the last 3 to 4 weeks. Very close to a breakout on Friday's close, could break out today. Stop loss at 1410, target price of 1600.
A breakout on IndusInd Bank, and of course there's fundamental news flow that might support that view as well, as MK believes that the stock is likely to be in the MSCI list soon, so perhaps that will give another leg up to that one. But Kunal, what about you? Which are the stocks you're watching out for?
So I'll go with the first one. That's about Avenue Supermarts or DMart. That's a stock which has done reasonably well over the last 1 week, formed a bullish flag pattern on the short-term time frame charts. would expect a breakout yet again for the stock. 4,200 as a target, stop loss at 30 at 30. And the second would be one ICICI Bank, the stock forming a bullish RSI divergence on the daily charts, especially on the early time frame rather, and would expect this breakout to continue for ICICI Bank on the upside. Targets of 1,000, stop loss at 935.
All right, there you have it. All of the top recommendations then down your way. Let's also find out then what are some of the stocks that are in news today. And in our studios, we've got Samit who is joining in. Samit, let's discuss two stocks then and begin with Tata Motors. It's critical because they're going to sell 9.9% stake in IPO-bound Tata Tech.
Well, yes, they had around 74.69% stake and they'll offload around 9.9% stake to TPG and another group associate company. Now, this stake has been valued at close to 1,600 crore rupees, which values Tata Motors' entire stake or Tata Tech at a valuation of around $2 billion, which is close to 16,300 crore rupees. Now, post this stake sale, the company would have close to around 65% holding, 64.8% holding in the company, which will be valued at close to 10,700 crore rupees. Now, why is this important for Tata Motors? Now, Tata Motors has been looking to deleverage its balance sheet. They aim to bring down their debt from around 41,000 crore that they currently have in their books to net. They want to be net debt positive by the end of FY25, and this will be one of the crucial stake sale going ahead, because Tata Tech is also planning to do an IPO where Tata Motors will look to sell around 20% stake. So this plus the free cash flow that the company has been generating will help Tata Motors to be net debt free, which they aim to do it by FY25. So this is one of the key moves or key positive coming in for Tata Motors, and we had seen a sharp surge in the share prices also on Friday, most probably on the back of this news, most probably. But this is a positive thing coming in, because also there's a benchmarking happening for Tata Tech's valuation at this point of time.
What is so unique? I'm just thinking through it. What is so different about Tata Tech, which let's say TCS and Tata Elxsi, they don't have to offer?
Well, actually, Anisha will be able to tell us that more.
I've not looked at it, so it's like an open-ended question. Anybody can answer.
Yeah, no, so there are quite a few overlaps, to be honest, because both of them do cater to the transport and the aerospace industry, but the revenue that they get and the product services that they have is slightly different. So, for instance, Tata Tech does a lot of, help them to concept design the cars, as well as, streamline the manufacturing process and all of that, while Tata Elxsi is also supporting the automation of the entire car. So, within the car, the software that goes is something which Tata Elxsi works a lot more on. Yes, there are overlaps still in terms of body engineering and all of that, but slight differentiation, and that is there for you up on the screen as well. So for Tata Elxsi, for instance, they get 45% of the revenue from transport, while 75% for Tata Tech comes from transport. So the dependency on aerospace and transport as a vertical is much higher when it comes to Tata Tech. Even geographically, if you look at it, America is what forms 40% of business for Tata Elxsi, whereas for Tata Tech, it's only 20% of the business. Their larger exposure comes from Asia as well as Europe. So slight differentiation. But yes, both have a headcount of almost 11,000 crore. Revenue profile is pretty much similar, 3 to 4,000 odd crores. Slight differentiations. And in fact, analysts were talking about how for some of the orders, the companies might compete with each other as well, if not have a JV. So let's see how this really pans out.
Okay, now just imagine that right now PE investor has invested and they've set a benchmark. Now, if the stock does what, let's say, Tata Elxsi did, then we are looking at a big re-rating when the Tata Tech IPO will go public, and it will always have an interplay in terms of the sum of part what it will have on Tata Motors. Now, what it means for Tata Motors here, look, the issue is going to sail through. The pre-IPO investors had kicked in. It's going to be pretty much on the path of what they've said, that we want to deleverage the balance sheet. But the interesting play here is that if you compare Tata Elxsi and Tata Tech, there are synergies and there are similarities. There are similarities which you need to focus on, because Tata Elxsi, we know that what kind of re-rating candidate it has been, given that the size of the business and given the nature of the business. So if Tata Tech does even 50% of what Tata Elxsi has done, I think we got a real big IT company which post-listing, that really could be the surprise factor. What it does for Tata Motors may not be that great purely looking at the sum of part. But I guess here the important bit for me is that Tata Tech now is getting valued independently, and it's got everything what perhaps what markets want. A Tata Group company, similarity between Tata Elxsi, same growth profile, similar headcount, and it's got blessings coming from internal companies in terms of getting businesses. So for me, I think Tata Tech is the more exciting part when it goes public, looking at the similarity in the benchmark valuations which have been set.
Yeah, and as of now, I guess you could say that Elexi brings a little more design to the forefront. TCS, of course, is comprehensive IT, and Tata Tech is blend of engineering as well as digital. But yes, that is what we'll be watching out for. That aside, let's keep the spotlight then on Dalmia Bharat. Came out with their overall Q2 numbers. What exactly are analysts saying now? Because I believe they're saying that this is just the sign of things getting better down the line as well.
Well, Dalmia Bharat is one of the largest cement companies, and in fact the first one to come out among the large players with the earnings, and the numbers are pretty much looking stable. Now if you see the EBITDA, that growth has been much ahead of what the street was expecting. In fact, it's a beat of around 5 to 7% compared to consensus estimate, and this is largely on the back of the fact that the cost side was pretty lower for Dalmia Bharat. There was easing of when it comes to fuel costs because pet coke prices were on the lower side. Also, logistic cost has come down for Dalmia Bharat in the second quarter, and based on these factors, the Q2 EBITDA was a strong beat. When it comes to volume growth was around 6.6%, but this brings the H1 volume growth to around 10%. Now, everyone knew that the Q2 volume would be weaker because there's a seasonality factor that kicks in. But for first half of financial year 2024, the volume growth has been 10%, which is a double-digit volume growth, and this means that at least for the full financial year, the company will easily grow more than 10% on the volume front. Now, pricing was an issue because of which even if you see the realizations in the second quarter have been weak. But given the fact that there have been considerable price hikes that have been taken in Q3, that is from October, this concern also now goes away for Dalmia Bharat. Now, price hikes have been in the range of around 50 to 70 rupees in some of the regions. So, which means that from H2, the realizations will also be better. Now, obviously, some cost has also increased, but the fact prices have increased more than the cost will definitely benefit the EBITDA more going forward. So, all in all, Q2 is a stable set of numbers, while outlook also remains good when it comes to cement company like Dalmia Bharat.
You know, we don't talk about cement at all. We just written off that sector. And I think, can cement really make a comeback? Cost pressures are really coming under control. The check prices in terms of whatever metal, whatever we've seen in terms of coal prices or met coke prices, they've been able to pass on. Now, Dalmia Bharat is not a mid-cap cement company. It's got size and it's got presence at least in southern India. So numbers coming from then for me would be a reflection of what we should expect from Ultratech and ACC Ambuja, because they are already efficient companies, and the ACC Ambuja efficiency is increasing every quarter. So I think cement in a sense has just been a disregarded sector. It's just been off the radar for a lot of market men. But in the second half of this year, I mean, if you're bullish on real estate and roads and infrastructure, then better be bullish on cement. I always find this very strange that, okay, we like real estate, more houses are being built. We like infrastructure, more roads are being built. We like real estate companies because we like commercial real estate. We cement to le lo. Now, the point with cement is that they did not have pricing power advantage because of the cost pressures. Now that's getting nullified.
No, but Nikunj, the point is, yes, it's been written off, but you're talking about the second half of the year, but coal prices have increased quarter on quarter, and so is the crude prices.
They've been able to pass on. See, my limited point is that same time last year they were struggling. They were not able to they were not enjoying what could be called as pricing power benefit. See, any inflationary pricing is always great news for a sector which is able to pass it on. Because when prices come down, the proportionate cut is always not in tandem with what the price hike is. That is what the advantage of pricing power is, and that's what cement sector is going through. Are you seeing a drop in cement monthly dispatches? No, sir. The answer to that is yes. Is next 6 months, 12 months in the run-up to the election be a strong one? And you know, whether it is the state government or the central government, everyone has recognized that the multiplier of the economy is coming not by giving freebies. It is actually coming by spending money on infrastructure project where ROI or the multiplier is actually 1:3 or sometimes 1:4. 1:4. So I think you pretty much know that which way the government is saying. You know, it's like saying 3 months ago, if you bought into anything which would have benefited from cricket, today you are seeing evidence of that.
Well, yes, and EBITDA per ton was definitely some evidence when it comes to Dalmia Bharat, almost at 950, beating the street estimates. Thanks, Amit, for being with us in the studio and talking to us about some of those stocks. But let us bring you an exclusive news break now. Extended trading hours for equity derivatives is unlikely to be, brought into force anytime soon. So that's the big news that we are learning. ET now has learned from sources that SEBI is in no hurry to accept NSE's proposal. The market regulator will take a decision after assessing risk management, settlement process and manpower requirements. Ankur Mishra, my colleague, is joining us with this latest exclusive. Hi Ankur, tell us.
Yes, sources say that market regulator SEBI is going to have consultation with market participants before giving go-ahead to trade time extension. The regulator is going to check what is the preparation on risk, what is the preparation as far as settlement is concerned, and also the preparation on manpower, among other checks and balances which regulator is going to apply before considering the trade time extension. Remember, NSE, after claim to have discussion with the stakeholders, has sent a proposal to SEBI for an extended session from 6 p.m. to 9 p.m. in the evening, and that was proposed in the FNO segment in the indices only, so that the traders get a time and opportunity to trade and react to the global events if they want to. So this proposal was sent to SEBI, and after that there has been several questions which has been asked by SEBI to the exchange, and that process is continuing. But before giving a final go ahead for trade time extension, SEBI is carefully examining the proposal. It is going to have consultation with all the market participants before moving ahead with the proposal.
Source-based news break. This is a source-based story. This is not official. We've not heard anything from the exchanges or, for that matter, from the regulator. Now, this is a big news break. 3 weeks ago, exactly 3 weeks ago, there was a view and just about markets, and everybody was getting ready that the trading hours would be extended. And the narrative which in a sense supported that, it in a sense was some kind of an indication that the final approval was just with the regulator. Now what Ankur has learned, that NSE says extended session is aimed to offer Indian traders faster reaction to global events. That's the logic. But what we know is that SEBI is unlikely to give a go ahead, or if I may use the Hindi word hari jhandi, anytime soon. That does not mean that the trading proposal, that the proposal to extend trading hours in the FNO category has been cancelled. It has been derailed. But in terms of the real extension, it is unlikely to come anytime soon. So that's the big story Monday morning for our viewers. NSE proposal, market regulator is still examining NSE proposal to extend FNO trading between 6 to 9 p.m. and that is unlikely to get extended as SEBI has to understand risk management, settlement process, manpower requirement, banks and a whole lot. Kunal, I mean, aisa thodi button daba kaam ho gaya.
Absolutely.
See, banks will shut, exchanges will shut, money has to come out, Bhav copy will be generated. A lot, there is the entire procedure.
There's a whole structure behind this because this is going to be a different entity altogether. See, I think the biggest concern is the expiry. Because if you're having an expiry at 3:30 p.m., then would you call this as a normal hour or post 3:30 if you extend it to another 6 to 9 or higher? Would that be an extended hour or would that be just as an inclusion of a normal hour?
And the index moves because of the underlying stocks which move. So if Reliance goes up by 5%, if Infosys goes down by 3%, it's the impact of these stocks in the cash market which leads to a derived value of the Nifty. Now if the underlying cash market is not going to trade, and if only the FNO market will trade, then how will the derived value be done? For example, TCS numbers, they come at 6 o'clock and index is trading. So technically, how would you come at the derived value? Infosys comes out with a profit warning, the ADR goes down by 6%. NSE and Nifty is trading. So how do you come out with a derived value? So that is something which I think which still needs to be understood. Isn't it?
Yeah, absolutely. And one more factor, the reason why I'm highlighting options or the expiry is because there are a lot of Greeks in terms of options, theta, DK, etc. They get calculated post 3:30 only or at 3:30 only. And that I think would probably change the pricing of options also.
Yeah, let's connect with Shilpa Raut as well, derivatives lead analyst at Prabhudas Leeladhar joining in. Shilpa, good to have you on board. As of now, we've picked up from exclusive sources that SEBI is looking to consult market participants with respect to a change in the overall settlement process and the trading hours that could potentially be extended. Just wanted to understand what the implications would be for this. As our chartist Kunal was saying, the biggest question mark is going to be on expiry. Do you think that is one of the leading, key points that you'd be watching for?
Good morning, everyone, and thank you for having me on the show. To discuss this, I've already, been hearing from all your participants, all the panelists there, discussing about the pros and cons for this move. But sooner or later, I believe this move will come because we have to also get into the grasp of, 22 hours trading window that we see throughout the global market happening. So in this regard, this decision will come sooner or later. But of course, before that, this examination and this, the time that SEBI is taking to analyze all the developments that have to happen before this move comes in is very, very appreciable. It's not only about the manpower that, the brokers have to think about increasing, but also about, what kind of participants will be there in that extended hours. We have already seen, the report by SEBI that 9 out of 10 F&O traders, they are already making losses. So will it be 10 on 10, or this will actually give some sort of a platform for those traders to react to global markets and, take their positions lightly. But also you guys were discussing about how the underlying, if there's no underlying happening in those hours, then how will the Nifty and Bank Nifty be calculated? That is also one thing. Of course, they must have also taken this into consideration. The things that we are discussing now, I'm sure the NSE must have taken everything into account. But this entire thing has to happen sooner or later. Before that, this sort of preparation time that is being taken is something that we all need to have patience and see what has been decided by SEBI. So whatever the outcome is, we will have to just be ready with it.
Okay, wait and watch. That's the word coming in. Shilpa, thanks so much for making time. But we also have Sanjeev Bhasin, director, joining us on this show. Sanjeev, hi. Thanks so much for making time and speaking with us. Let's start with Tata Motors. I know you were a fan at least a few months ago. But after this kind of valuation uptick that we have seen coming in on account of this Tata Tech, stake sale as well, do you think the stock is likely to get a leg up, or do you think it's factored in the price?
Yeah, good morning, Anisha. Firstly, Jai Mata Di, wishing all a very, very happy and prosperous Navratri. And yes, the optimism should be back. Tata Motor has been a dream stock. As a disclosure, we own it for much lower levels, but a large part of that may be in the price. The fair valuation for TTML, Tata Tele, the listed arm or the unlisted arm, will come of time. But I think maybe they were in a hurry to encash it to, shore up their cash. So that's why they came out with this. I think Tata Motor is fully priced. Anisha, if I had to go, I would go with Ashok Leyland. That would be my top pick. By the way, firstly, let me tell you, the weekend has been superb. India drubbing Pakistan and Afghanistan beating England. So I think take it with a pinch of salt. We are on an optimistic note, particularly in Asia, the World Cup, the type of spending, the type of, record rush you saw in Ahmedabad, and it's only going to get better. So good times are here, and by the grace of, Jai Mata Di, we would be very, very positive on the market bend going forward.
Oh, yes, indeed. And of course, we did see a great victory as well pan out on the cricket stadium over the weekend. But that aside, it's a very busy week, Sanjeev. Lots of big numbers. And Nikunj was alluding to the fact that the FMCG sector is going to be very closely watched out for. Ultratech Cement, HUL, Nestle, ITC. What is your outlook on all coming in one day is what I mean. What's your outlook from the FMCG majors?
Yeah, so Avan, actually, if you see in the last week, actually FMCG has started to hold out. Some of the banks and IT stocks, because of Infosys, have taken a backseat, and there is a sectoral shift. Maybe I think Lever and ITC had come down to valuations where they became again attractive. And like you said, there can be a little bit of pressure on input margins and the volumes. But now we are looking at the best period which is there as far as sales go, as volume, and as far as new products. Nestle has taken the cake. I would say add a Marico over here. Most of the weak earnings may be in the price, but the type of product portfolio Marico has, that is one stock which we are accumulating. So Nestle, Marico, and I think hold on to Lever because it may have bottomed out in the last 1 month, and it could be the one which can give legs to the Nifty going forward.
Nestle, Marico, HUL, these are the names to watch out for when it comes to the FMCG majors. But Mr. Vaseem, just hold that thought. We're just quickly going to take a 30-second break and be right back.
Welcome back. Still tuned into the market. We're in conversation with Sanjeev Bhasin, getting his outlook on the markets as well as some of his top recommendations. Then there's HDFC Bank's combined entity quarterly numbers that will come out today. Sanjeev, what should the street brace themselves for?
Well, I think most of the bad news will be priced in. You have to give them a couple of quarters for them to consolidate. Yes, the average yield will have fallen, but that is already in the price. I think this is a brilliant time to accumulate the 7th largest bank. There can be another 2 quarters of underperformance. But I am, on the other hand, very, very optimistic on their CASA ratio growth, their credit expansion. And I think this 1500, 1525 levels is a very good time to accumulate. Results, Savan, according to me, may be a little bit of a beat on the upside, and we'll take it with that. But the language going ahead, they've been very, very conservative and always over-delivered. And that's what I think will be the going forward.
Okay, so that's about HDFC Bank. But what about Avenue Supermarts, Mr. Bhasin? Because the numbers were a bit somber, at least on the margin front, they were a bit disappointing. But the question that Street is asking now is, A, is it priced in already in terms of the negatives? And is it perhaps the bottom? And from here, we'll see a sharp recovery. Your take?
Yes, so Anisha, see, Avenue Supermart has been on an expansion free, and as you open more outlets, the net costs add to your margins for a time being. I think they have now reached maturity level, and like you see, you've seen the other supermarts, all of the likes of Geo, the likes of Trent, and so on, do extremely well. So Avenue is a quality stock. I think it has underperformed the market for the right reasons, but I think all of that is in the price. Look, if you are optimistic on the spending patterns, and I think once we are through this geopolitical tension, there will be a sharp comeback, particularly on some of the stocks which have underperformed and which have now enough firepower to take you higher. So I'm not a fan of Avenue Supermart because it has always been a very expensive stock. But I think given the pedigree of the management, the new branches which they've expanded, because whenever you go to tier 2, tier 3 cities, all you see is Avenue Supermart. So I think their brand expansion will pay out. The next 2 quarters could see margins actually accrete on the upside.
Just reading this morning's headlines, Sanjeev, and a lot of focus as well on real estate. For instance, Prestige is talking about how bookings will hit the 20,000 mark. There's also redevelopment in Mumbai of the slums with Lodha and the stocks. We've seen the kind of terrific rally really play out in real estate. Is it still a good time to enter, and where?
Yeah, so Aman, that is what most of the people are missing, the woods for the trees. It's capital goods and it's real estate. I mean, DLF and Godrej are hitting recent new high. DLF is hitting all-time highs, and so have the capex stocks. You've seen the likes of Puravankara, the Brigade, and even over all of them, because it's the wealth effect. Aman, gold at new highs, stocks at an all-time high, and the wealth effect is tremendous in the upper 10% of the category. And that's why you've seen real estate get mopped up. It's not for any reason that a 10,000 square foot in Camellias got sold for 100 crore. Maybe 100 crore was a one-off. But still it tells you that the appreciation in capital assets is just starting. Along with that, you will have the inflows, that is cement, steel, copper. Copper prices are again up. So you cannot, that is what the market is pricing in. And you've seen, along with real estate, NMDC, GMDC, which are core earth producers, they are doing extremely well along with Coal India. So I think this is telling you that the capex side, the real estate, the wealth effect is tremendous in India, and it's just starting off.
Well, the effect is tremendous, Sanjeev, but are people spending that on the likes of PVR Inox because they have come up with a subscription plan, or they are, you think, gambling it away with the likes of Delta Corp because that stock has been in a bit of a tizzy, and now 6,300 crore worth of more, tax orders that the company has got?
Well, remember, orders are very easy to pass. It's the litigation and the pass-through which takes years, maybe months or years. And sooner rather than later, there will be litigation which will solve that. You cannot have a better business than casino and online betting, which is gathering more steam, and it's where the new millennials are putting their money. So there will be an afterthought on that. And like I said, I think PVR Inox would be a very good proxy play to how spending patterns for the common man picks up. We've had a buy on GFL, that's Gujarat Finance Fluorochemical, which is GFL. That stock has been on a tear, and we still think that some of the underlying sectors which are, not that well unnoticed have started to perform. So who thought that GMDC, NMDC will be coming to new highs? Who thought Coal India will cross 300? It's on the back of superb, actually, businesses which are now getting realized. And I think copper and steel and aluminium will be even do better once this, because of this escalation of geopolitical risk.
Okay, so those are some of the stocks that you like. But since you were talking about real estate, Sanjeev, and the fact that you like it, people are missing the forest for the trees. But what about the cement names? Because we were discussing that's one sector which had been written off per se. Which are your top recommendations?
So we have a disclosure on Ultratech, ACC, Ambuja and Dalmia Bharat. These are 4 stocks which are under our coverage. We have ownership in them, and we think that they are bound to outperform. In fact, I see Ultratech in 5 digits, 10,000 rupees. I see ACC, Ambuja being the biggest beneficiaries because of the Adani reduction of debt. And you could it was for the asking 6 months back when fear drove those. Those are very, very well run businesses. Dalmia Bharat itself now, after the JP acquisition, becomes a rather big play in the middle of Bharat, in Madhya Pradesh and so on. So I think cement is a no-brainer given that price increases will be passed on, and the best of the construction pattern, whether roads, infrastructure, commercial real estate, is all on the anvil as growth. And that's why you are seeing the markets take a precursor, and those stocks and sectors tend to hit new highs before the time.
All right, Sanjeev, going to let you go on that note. Thank you so much for taking time out and joining us today. Let's move on then. Stocks on the editor's radar, and today the spotlight is on heavyweight IndusInd Bank and the MSCI rebalancing announced on the 15th of November. With respect to flows as well, the stock is going to be monitored.
Okay, in the near-term markets are always obsessed with flows, liquidity. That always is the short-term indicator of sentiment. Now, according to the shareholding pattern, the headroom for flows to come back into IndusInd Bank automatically will increase. Now, the Bank Nifty has had a flat year, but IndusInd Bank has had a good year. It's up 20%. The stock post-LNFS crisis went into a state of recalibration. They had to bring the growth down. They struggled in terms of getting the order book in getting their NPA trajectory right. But now, IndusInd Bank for last 2 or 3 quarters, in a sense, has delivered. It is still very cheap. But considering that the rate of the change, which I always focus on when I'm analyzing any company, I think the rate of change for IndusInd Bank is constructive. Now, IndusInd Bank, the negative bit here, Avan, is that it does not have a pure insurance play, does not have a big securities business. It's a pure, plain, vanilla bank. That, in a sense, could be the restrictive factor for IndusInd Bank going forward, because for ICICI Bank or SBI, HDFC Bank, those have now become one play solution with insurance, securities, and also the brokerage businesses. That is the missing link for IndusInd Bank. But in the near term, according to MK, there could be an inflow of $250 to $3 million. The stock is still cheap. The momentum is on the right side. There is an indication that the Hinduja Group is looking at increasing their stake. And with Mr. Katpalia's extension now firmly in place, it's not a bad idea to just keep this one on your radar.
All right, that's the view coming in, Anisha, on IndusInd Bank.
Okay, let's take the view of Sandeep Sabharwal as well. He's joining us on the show. Sandeep, good morning. You heard our thesis on IndusInd Bank. What's yours?
I think broadly it seems to be in line. So we've seen that the volatility in performance of IndusInd Bank has come down substantially. Now, the key challenge obviously will be for them to maintain their asset quality, because that's the important parameter for IndusInd Bank, and that's the reason why it got downgraded in the first place. While at one point of time it was talked of being emulating HDFC Bank, etc., but then it fell because of the NPA issues, etc. And now it's coming back. So I think broadly, it's a decent stock to hold.
Sandeep, there is a reason why you should avoid IT, and there is a reason why you should buy banks. But markets are not really looking at the obvious, which is that for banks there is a lot of visibility, and for IT there is a lot of fog on the windscreen. The price action even on Friday, let's say for IT, despite post set of numbers from Infosys and HCL Tech, was not that scary.
It's not, because I think there are too many people who just want to buy IT stocks, and that becomes the risk for the performance of the IT company also for the future. I think the whole swath of retail investors, they're always looking at buying IT all the time, because that's what has worked for them in the past. So I think what's worked for them in the past, they believe that it'll keep on working. I think the picture is quite fuzzy for IT companies, at least in the short run. So now I was reading a lot of IT company reports over the weekend. Many analysts are penciling in 12 or 13% earning growth next year, and then picking up in 2026. I don't know where those projections come from when the companies themselves don't know what's going to happen after 2 quarters. What's the basis of all these projections? I think IT remains restricted. Financials, I think there's some growing concern among the investors and analysts about the impact of rising interest rates and what it will do to potentially to the asset quality, especially on the unsecured loan side. Now, I personally don't see that as a big challenge. I don't see any indications of that deterioration happening. So I think what I would think is that as results start coming out for many of the banks and people see that there doesn't seem to be a deterioration in asset quality, although NIM squeeze is a given, then we'll see the financials again start to come back.
You got HDFC Bank numbers today, Sandeep, and could it be one of those cases where you buy the rumor and sell the news ka ulta? Nobody's expecting anything from HDFC Bank. They've come out and already indicated that there would be ample liquidity and the return ratios in the near term will remain under pressure. So markets know that the stock is underperforming. But today, if you get something exciting from the number, maybe the trend could reverse.
Yeah, if they give something exciting, it's possible, but I wouldn't bet on it. I think they are facing significant challenges related to refunding the loans because of HDFC acquisition, meeting SLR, CRR requirements, etc. Even after they've got priority sector lending leeway from the RBI. I think it's going to be challenging for HDFC Bank in the near term. And everyone and their uncle are I would say, throat up full of HDFC Bank. So I don't think from the large investor standpoint there's any scope for them to keep on buying HDFC Bank now, because all mutual fund portfolios, if you see top holding in all flexi cap, multi cap, large cap funds is HDFC Bank only.
Sandeep, when you say everybody is knee up in HDFC Bank, I would say everybody is drowning in HDFC Bank. Knee up तो कम होता है, ये तो ऊपर से भी हो चुका है. I mean, everybody is drowning in HDFC Bank. Where will the new buyer come from? Which is what we have to understand.
Yeah, that's what I said. First I said knee up, then I said neck up, but then I think you said head up. So I think
I'm saying drowning. I'm saying drowning. I mean, I'm yet to find somebody who says I don't want to buy HDFC Bank or I don't hold HDFC Bank. I mean, I've got folks who've been, in my friend circle, when I meet people on the street, when I speak to some of the fund managers, there is not even a single bear on HDFC Bank. Kunal, Nuresh, not even a single bear in HDFC Bank. Am I right if I say that?
Yes, very much.
Nuresh, एक bear भी नहीं है HDFC Bank में.
There are no bears. There are no, say majority of the people are looking at HDFC Bank as a buy purely because for a long period of time, the stock was never cheap on price to book or various reasons. But We've seen this happen with a lot of these companies, larger names. So there was a time where Reliance went out for many years sideways. Even in the last 2 years, if you look at it, ever since the fundraising which happened, the stock was 2,300. Then today, even if you add the Geo Financial, we are not at 2,700. So 2 years returns has not been great. And for the last 2 years, for a long period of time, it was below 2,300 mark. So we are getting into that zone for HDFC Bank. Similarly, what has happened with a lot of large caps, wherein you've had a good cycle and then the stock goes sideways for different reasons. So HDFC Bank is the preferred bet among a lot of HNIs. It's the hiding place for people, those who want to have equity exposure but don't want to have a lot of beta.
Sandeep, Geo Financials. Now, it had a good debut. It is now at 220. But at 220, it has a market cap of 1,50,000 crore, and technically, and right now it has no operating business. So, do you think market should take a leap of faith, saying that okay, Geo Financials, it's a Reliance group of company, they will get it right eventually, and this could be a big one from 2 to 3 year time frame?
Because we have to look at history and how Reliance has been able to do things. So I think in many businesses, they have been able to scale up, but not necessarily profitably. So, and I think that is the challenge. That's one part. Secondly, financials, unlike many of the other businesses where you could get, there could be regulatory issues, there could be entry barriers because of various things. In financials, they are well established, large size financial institutions across the banking and NBFC universe. And some of the fintechs also are reasonably well established and large now. So I think it's not going to be a free run. So in the financial space, for someone to start very small and grow rapidly in the first few years, that's always possible. So once Geo Financial starts growing, the initial run up in growth will be very fast. But a lot of it is already in the price. So I would think that we could see the stock for a long time not do anything. And then if they are actually able to establish a business which is seen sustainable and profitable, then that's the time stock will perform. But I don't think it's going to happen in the near future.
Avenue Supermart. Growth has come back, but where are the margins? Kunal is bullish on the stock because technically the stock in a sense has done quite a bit now. And it, Kunal, you've been liking the stock for 2 weeks now, right?
Yes, Nikunj, absolutely.
See, I track you so closely. Sandeep, why are you smiling every time on DMart? Every time you have a smile when I say DMart.
You are tracking Kunal because you are owning that.
Sir, I missed the last part. Are you tracking Kunal because?
Because you own the stock.
No, I don't own the stock. As a disclosure, I don't own the stock. But in generally, I'm intrigued with DMart simply because, Sandeep, because here's a company which has a great proposition in terms of growth, management bandwidth, and where it could go. But in terms of the P multiple, every time I look at it, it makes me slightly uncomfortable.
Very expensive stock, and if you if you look at it, the return ratios have been constantly declining over the last few years. So they used to be nearly 22-23% ROE. It's come down to 14% because initially they were very conservative in expanding, so they were just squeezing out growth from the existing properties, which was high ROE. Then they obviously got to know, realized that they cannot squeeze the existing properties any further. Now they are on an aggressive growth path. They'll be investing 2,500 to 3,000 crores every year for setting up new stores, 45, 50 stores every year. And that could further depress margins because growing in existing markets and going into new markets where there might be some other established players and trying to grow there with similar margins is going to be difficult. PE ratio on current year basis is around 95 to 100, depending on what you assume for earnings. And for next year, around 75 times, even if we assume a 25% earning growth next year. So it's a very, very expensive stock, leaving no scope of appreciation for investors, in my view.
I want to go back to that story. There's a big ET Now exclusive that unlike what all of us thought, that the exchange timings would be extended in the F&O market, it is unlikely to happen near term soon. It's not been shelved, but the extension is unlikely to come in a hurry. So we don't know the timeline. When I say hurry, it's not going to happen in this financial year per se. That is what we understand. Sandeep, time and again we've gone back to this whole issue of, does India need extended hours? Now there's a global practice where S&P futures and Dow futures, they trade round the clock. But that is for US, and that is a $30 trillion economy. India is a $4 trillion economy, and our market size is minuscule of what currently the US have. So while exchanges have the logic in connecting the dots here, do you think we need to be realistic in terms of where we are and what the extension will do for us?
Yeah, and what's the value it will add? Because, if we have read of so many studies done by the regulator themselves and some other large broking houses that 90-95% of the people trading in F&O actually losing money. I don't know that maybe that those statistics are right, maybe they are not, but I'm not sure, but I think that's been put out. Now, in that situation, why do you want people to trade more at a time, and it will lead to a total I don't think there'll be huge volumes there. It will lead to a lot of distortions and possibility of manipulation, because 6 to 9, who wants to sit and trade? I think very few people will be doing that in any case. And effectively, there's very little value which will get added. So I think that's a realization which is coming. So although it might not be officially shelved, I would think that it should be something which is effectively shelved.
All right. Meantime, Sandeep, what's the outlook on when it comes to the entire hospitality space? For instance, revenue growth on the back of healthy room rates is what the expectation is. Of course, the Cricket World Cup frenzy has sent prices spiraling through the roof. But within this entire listed space, what is it that gives you comfort? Is it Indian hotels only?
See, across the board, hotels are doing well, and I think the hospitality space is in a very good position, at least for the next 2-3 years more, before we could see potentially capacity additions catching up with demand growth. So Indian hotels is in a good space. It's been consolidating for some time after a sharp run up, but I think they'll continue to do well. Their strategy of going into new areas and tapping new segments, I think, is a very good one, and it's working well. Lemon Tree also is now in a phase where they could actually start generating free cash flows, and as a business hotel, it's very well positioned. So I would be positive on both of them.
We've also got Jio financials numbers out later this week. Is there anything, Sandeep, if you track the company, that you think the street will be closely watching out for?
I don't think they are doing much. So I think it will all be commentary on what they are going to do. That's what people have to monitor.
Okay. Let's look at specifics of Tata Motors here, Sandeep. I mean, we are talking about Tata Tech here, which now is a benchmark valuation which has been set because of pre-IPO. Anisha was doing numbers in the morning, and there is a similarity in the model of Tata Elxsi and Tata Tech. So do you think the story here is not Tata Motors, but it is Tata Tech? Because after TCS, this would be the first Tata company which actually will go public. And if one really uses Tata Elxsi as a benchmark, then this stock has a long way to go.
Yeah, it's possible. So I'm not if that's the kind of business analysis, because I'm not got deeply into that. But then if they are able to get those valuations and then the IPO happens, I'm sure given the pedigree, the performance also will be good in the initial phases. And then as the actual numbers come out, it will follow. So I think that's one part. The second part, obviously, is that Tata Motors as a in its core business itself is doing well. And that's led to the re-rating which we have seen. But what most people don't realize is they see the price movement, they don't see the valuation. So if you look at valuation, the stock is still not expensive. Tata Motors as a stock, I don't think it's still expensive.
What has kept you busy, Sandeep? Where have you been shopping? Where have you been? And I'm talking about market shopping here, not where you were shopping in terms of your retail habits. Where have you been shopping?
So I think where I've been adding over the last many weeks has been Voltas and Aditya Birla Retail. So I think those two are subdued stocks. I don't know when they'll start performing, but like what we did with Bharat Forge and Lupin for nearly a year, we kept on accumulating, and then as positive triggers came, those stocks performed. I would think that a similar thing will happen with these two stocks, but it's there for long-term investors. I don't know what will happen after 10 days, 15 days, but I'm sure over the next 1 or 2 years, these stocks should do well.
Understand. Aditya Birla Fashion, Aditya Birla Retail, in a sense, has diversified too much. Unlike, let's say, a Trent or a Shoppers Stop, they don't have a focused portfolio. So my problem with Aditya Birla Fashion, historically, Aditya Birla Retail has been that they are spreading themselves too thin. And in the retail business, you cannot do that. Isn't that a valid concern for Aditya Birla Finance or Aditya Birla Retail?
Yeah, it's a valid concern. That's why the stock's down from 360 to 220. So I think there was an expectation post-COVID when you listen to the management, etc., that they are focusing on free cash flow generation. They are not going to do random expansions, etc. Then they went ahead and did a few acquisitions which were not liked by the market. So we never bought at that time. But I believe that most of the negatives are in the price now. They have very good brands on the apparel side. And as cotton and input prices remain subdued, inflation comes down. That's the first segment which will see a revival on the retail side. And there are already indications of that. So I think that's the bet. They're a credible player, available relatively cheaper than like nearly 40% down from where they were just a year back, I guess. And all the negatives are in. So as the performance picks up, we'll see performance coming from the stock also.
Okay, Sandeep, on that note, we let you go. Thank you so much for making time and speaking with us. But let's get some ideas from our chartists now. Kunal, you go first. What are the top mid-cap recommendations?
I'll go with the Bayan Welspun Corporation. Excellent chart for the stock. Last 4 days, it's rallied up 15% from 380 to 440 levels. Perched at a fresh 52-week high for itself and nearing its lifetime high level. So looks attractive as a setup. Would look out for a buy. Targets closer to 466. Stop loss at 426.
What about you, Naresh?
So that would be a buy on JK paper. The stock has been trying to make that breakout move of 405, 410 levels. Saw good volumes 2 days back, pulled back a little. Expecting this to break out going forward towards 450 and towards a new all-time high. A stop loss at 380, target price of 450.
Move on and revisit our exclusive story. Extended trading hours for equity derivatives. That is unlikely anytime soon. ET now has learned from sources that SEBI is in no hurry to accept the NSE's proposal, and the market regulator will only take a decision after assessing the risk management, settlement process and the manpower requirements. Let's get an Ankur who joins in with all those exclusive details. Ankur.
Yes, sources say that market regulator SEBI is going to have consultation with market participants before giving go-ahead to trade time extension. The regulator is going to check what is the preparation on risk, what is the preparation as far as settlement is concerned, and also the preparation on manpower, among other checks and balances which regulator is going to apply before considering the trade time extension. Remember, NSE, after claim to have discussion with the stakeholders, has sent a proposal to SEBI for an extended session from 6 p.m. to 9 p.m. in the evening, and that was proposed in the FNO segment in the indices only, so that the traders get a time and opportunity to trade and react to the global events if they want to. So this proposal was sent to SEBI, and after that there has been several questions which has been asked by SEBI to the exchange, and that process is continuing. But before giving a final go ahead for trade time extension, SEBI is carefully examining the proposal. It is going to have consultation with all the market participants before moving ahead with the proposal.
Okay, thanks Ankur for that, but let's...
Meantime, cricket lovers have clearly been munching on their favourite foods while watching the World Cup match. The global event has added new flavors to the delivery and OTT platforms as well. The India-Pakistan match was absolutely favourable. Instamart said they witnessed almost a 30% increase in orders compared to the weekends. Hotstar has also claimed that they've reclaimed the global on-demand video streaming record, with the match drawing 3.5 crore viewers on Disney Plus Hotstar, breaking the 3.2 crore viewership record that was set during the IPL finale.
Okay, time now to put the spotlight on IndusInd Bank, and here is the editor's take on that one.
Okay, in the near-term markets are always obsessed with flows, liquidity. That always is the short-term indicator of sentiment. Now, according to the shareholding pattern, the headroom for flows to come back into IndusInd Bank automatically will increase. Now, the Bank Nifty has had a flat year, but IndusInd Bank has had a good year. It's up 20%. The stock post-LNFS crisis went into a state of recalibration. They had to bring their growth down. They struggled in terms of getting the order book in getting their NPA trajectory right. But now, IndusInd Bank for last 2 or 3 quarters, in a sense, has delivered. It is still very cheap, but considering that the rate of the change, which I always focus on when I'm analyzing any company, I think the rate of change for IndusInd Bank is constructive. Now, IndusInd Bank, the negative bit here, Avan, is that it does not have a pure insurance play, does not have a big securities business. It's a pure, plain, vanilla bank. That, in a sense, could be the restrictive factor for IndusInd Bank going forward, because for ICICI Bank or SBI, HDFC Bank, those have now become one-play solution with insurance, securities, and also the brokerage businesses. That is the missing link for IndusInd Bank. But in the near term, according to MK, there could be an inflow of $250 to $3 million. The stock is still cheap. The momentum is on the right side. There is an indication that the Hinduja Group is looking at increasing their stake. And with Mr. Katpalia's extension now firmly in place, it's not a bad idea to just keep this one on your radar.
That aside, let's move right on then and find out what the index calls are. What is it that our chartists are advising? There you go. 3 experts, 3 of them giving the same call. It's a whole recommendation on the frontline index. And that's the market moodometer, given the fact that, do remember, we're also going into an earnings heavy week. It's also critical that we are looking at the impact of the Israel-Hamas war as well on equity markets and on other asset classes. What about the Nifty Bank? It's going to be critical as well, given the fact that you've got big numbers this week. Hold call, that's the view on the Nifty Bank.
Nothing like a cup of coffee sometimes in the morning, right? Yeah.
To just wake you up and...
No, you woken up, but just to keep you going.
Extra, yeah.
Just to keep you going, you need that extra caffeine. Tata Global, let's get the stock. Too much of tea and coffee here. But stock's at an all-time high, by the way. I think it's at an all-time high.
Tata Consumers, yes.
Yeah. It's got this pattern. 10%, 15% move and then gets into the sleepy mode, then it has to then it needs a caffeine shot.
Yes.
Has it moving out of the slumber? Same time last year it was 750, 800. Now I think it is a 917. Can it go to 1000 soon?
Yeah, I strongly believe so, Nikunj, because in fact, as you rightly mentioned, it's the nature of many of the stocks to get into rally for a short duration of time, change the range, up the support, higher the base for these stocks on the short-term basis, and then once they consolidate for a couple of weeks or maybe a couple of months, in different cases, that's where we expect the stock to move up or start to move up higher. So, it's more of a very steady kind of a stock. You have to try and look out for opportunities in case if you miss out on, say, some sort of a rally, to try and wait out for that phase of correction or consolidation to enter into the stock. And Tata Consumers and many of the FMCG names actually fit the bill here.
Okay. Duresh, we've gone through this stress test last week and Nifty has come on the right side despite geopolitical tensions. The fact that we found support at a key level and we are advancing with the help of strong breadth and flows now, do you think before Diwali there is a strong chance that Nifty will be comfortably sitting above 20,000?
So not very far away from the current prices, say 19,700 to 20,000. It's just say a couple of percentage points. The problem is whether we can get trending beyond these ranges. So a new range is being formed at 19,400 to 19,800 roughly. And can we cross 20,300 or 19,400? That's the critical part. So for now, we are waiting for some of the heavyweights to actually give some indication of leadership. And that could happen post the numbers in some cases maybe. But overall, the bias is positive. The main thing to look for is whether we can cross 20,300. Because if you look at the broader markets, they're doing fine. You have the mid cap and the small cap indices just 2-3% away from an all-time high. So they saw a one-day big, say a shakeout a couple of few weeks back, but they've recovered really well. So the markets on the broader end is doing well. But in the heavyweights, we do not have leadership. So if you don't have a HDFC Bank, Reliance Industries, that's 20-25% gone, and then you add another 15% from IT. So that's like 40% non-trending. You have Kotak Mahindra Bank to add to it. So we need at least one of the heavyweights to actually give leadership, and we could be at 20,200, 300 itself.
Kunal, the ditto question for you. Dashera Diwali se pehle Nifty 20,000 ke upar.
Yeah, I strongly believe so. It's very much possible. It's just that we are digesting a lot of news flow, no effect, no major damage on the indices, and we're still stuck into this 400-500 point range for the index. And whenever we see one positive sign of a news flow coming across, maybe from the globe or from the domestic signs, I think we are setting for a breakout on the indices. So I'll agree over here that we are looking out for more on the upside. The tilt of the markets is on the upside. It's just that there is so much of news flow surrounding that we are consolidating. Difficult to anticipate when will the consolidation end, but whenever it ends, it has to lead into an ideal breakout on the upside.
Will it be Reliance? Will it be Infosys?
Very difficult to call. It could be the likes of Bajaj Finance.
It could be HDFC Bank also.
It could be Bajaj Finance.
Heavyweight. You need a heavyweight to hit you out.
It could be ICICI Bank. That's also you can track.
That actually has done nothing also. Very difficult to say where the real leadership of the market would come from. But eyes down for the first trades. We start a brand new week. You look at the market from the prism of crude, dollar index and commodity prices. Well, crude is really on a boil. So that is something which we need to be aware of. You need to be cognizant of. But in general, the markets are telling you something, which is that there are little worries and there is more participation. What is happening on the geopolitical front? I mean, there's going to be no ceasefire for next couple of weeks, so maybe it could be months. It could really linger into months now. And all at first rates on your screen, we're getting the first rates on the Sensex and the Nifty and on the Bank Nifty. It's a red across the board for all the markets. But the breadth, I think, is looking phenomenally better than what it has looked in a long, long time. So you're off to a great breadth. 1:4. 1:5. That kind of a market breadth always gives a bull or the bulls a spring in the stride, so to speak, right at the open. Now, what is really bouncing up on my screen, and I'm purely looking at the price action here, there is nothing meaningful, if I may say so. There is MMTC, which is up another 5%. There is a Easy Trip Planner up another 2%. There is Zomato. Well, you've got a comment already which has come from Swiggy. So Zomato is really racing to 112. Markets are getting now more and more convinced that the food delivery business, I think, is here to stay. Tata Motors, buy the rumor, sell the news. Well, the news is out. The rumor was there on Friday. Market reaction, no reaction whatsoever. Avenue Supermart. Okay, top line is coming back, but where are the margins? I mean, on this kind of base, if the margins are not there, the markets would say that, okay, it's a business where P contraction could happen rather than P expansion. State Bank of India just holding at 574. And Titagar, Tesmaco Rail, 8-9% up for Tesmaco Rail. So it is really moving in line with what the other fancied railway stocks are. It's just that it has a lot to catch up in terms of where it stands versus where others have moved.
Well, yes, and what's also supporting the sentiment on Tex Macro Rail is that strong result with 60% kind of growth on top line as well as bottom line, and the demerger happening and new green entities being created for green energy, etc. So all of that is supporting Tex Macro. But of course, it's the banking names which are on back foot. So HDFC Bank is starting a bit somber ahead of its earnings. IndusInd Bank as well, after that run-up that we had seen on Friday, is consolidating a bit. So not a runaway rally, a 1% cut coming in there. IT, that's actually bouncing back sharply. So HCL Tech is one of your top performers at the index level, 1% gain. Infosys is doing all right. And then real estate continues to build on to gains. So Prestige, Brigade, these are some of the names which are doing okay. The interesting bit there on the screen is the advance decline ratio. Look at the NSE advances, 1420 versus the decline of 461. This is, of course, when Nifty, Sensex, as well as Bank Nifty has started on the back foot. What's doing okay is NDCC, 4% higher on account of some order wins and tie-ups. Prestige, as I talked about. You also have names on the losing side. Delta Corp definitely deserves mention. 8% shaved off that stock. That stock has been under tremendous pressure of late. It's a 6,300 crore order that they have got for some tax, which is due for Delta Corp. So that stock is in focus. You also have DMart, which has slipped almost 4% now. And BPCL, Berger Paints, Asian Paints, some of these crude dependents, especially the paint names, are coming under pressure. Add to that list Apollo Tyres as well. There was one of the notes, but of course, the entire industry is a big user of crude. So all of these stocks are coming under pressure. So not a great start, but it's not too ugly as well. 19,700 at least is being held on for now.
Okay, broader market absolutely listless, by the way, at the current juncture. But let's find out what our chartists make of the market open. And as Anisha was saying, Kunal, it's really all in the advance decline ratio. What do you make of that? And the fact that we're seeing some of the frontliners taking a back seat to the likes of IndusInd, HDFC Bank?
Yeah, I think it's more or less very similar that the indices are consolidating because of the way the news flow is panning out across stocks. So I don't expect any major move on the indices, neither on the downside on the upside. 19,700 to 800 broadly has a very tight range for the day. Now in terms of stocks, Tata Motors is something which looks attractive, trading at 665 approximately on the spot levels. Would look out for trading the stock on the intraday basis and targets closer to 680 plus.
What about you, Naresh? What's the first trade that you are punching in?
So liking Power Grid as a defensive play, which could make a breakout move about 205 in the short term. So at 200, 201, the risk reward is good. The stop loss at 196, expecting a move to 220 plus.
Point taken. Before I let you go, actually, Kunal, a quick word on some of these paint names. Asian Paints as well as the other names are coming under pressure. Anything that you would look at adding positions onto?
Not really, Anisha. In fact, many of these stocks are actually looking weak in terms of the chart structure. Berger Paints very close towards a breakdown of the previous support of 550, so it's just 2 or 3% away from this major or critical support. Asian Paints has already confirmed a breakdown. It's managed to break below the 3,200 mark, which has been a huge support for the stock over the last 3 months, 4 months. So I think that's also given a confirmation of a breakdown, which means Berger Paints can also follow very similar kind of a trend. So would not be bullish on the stock and on the set of stocks, and would probably be on a wait and watch.
Okay, just to reiterate, Kunal, that stance on the Nifty Bank as well, it continues to remain a hold, right? But what would change the view to a buy if some of the larger banks, the frontliners, participated?
So I think the best way to trade is, wait out for this range to be broken out, because, we are stuck into this, I think on the Bank Nifty around 1,400 point range for the Bank Nifty, 43,800 approximately as a support, and closer to 45,200 as a major resistance. So, it's always best to wait out which side of the markets, the Bank Nifty is breaking out or an index is breaking out. It's very difficult to anticipate whether HDFC Bank would lead from the front or IndusInd Bank or XYZ stock from the banking name. So I will stick to the levels over here, 45,200 on the upside, 43,800 on the downside.